Welcome back to Financial Energy, where we decode the markets and help you build smarter, stronger wealth strategies. Today, we're diving into a retirement threat most people have never heard of: sequence of return risk. It weighs not just about how much you earn on your investments, it's about when you earn it. This silent killer could derail even a well-planned retirement portfolio. Let's break it down, talk about the danger, and, most importantly, how to protect yourself. Imagine two retirees with identical portfolios, identical returns, and identical withdrawal amounts. But there's a twist. One experiences poor returns in the first few years, while the other enjoys early growth. Guess what? One outlives their money and the other doesn't. That's the sequence of return risk. It refers to the risk of receiving negative investment returns early in retirement when you're actively withdrawing money. Because when the market drops and you're also pulling money out, it amplifies losses. You're depleting both capital and growth potential. Let's say you retired in 2008, right as the global financial crisis hit. The market plummeted over 35% that year. If you were withdrawing 4 to 5% annually from your 401k, your portfolio took a double hit: market loss and withdrawals. Now compare that to someone who retired in 2010, after the crash. They started withdrawals during a bull market recovery. Same long-term return averages, but completely different retirement outcomes. Sequence of return risk is dangerous because it strikes when you most vulnerable, right when you stop earning a paycheck. You're no longer contributing to your portfolio. You're withdrawing. That means you're forced to sell assets at a loss, locking in damage permanently. And with longer life expectancies and rising inflation, retirees need their money to last 25 to 30 years or more. So how do you fight back? First, maintain a cash reserve. Keep 1 to 2 years of living expenses in a high-yield savings or money market account. This buffer lets you avoid selling investments during downturns. Second, use a bucket strategy. Divide your assets into short-term, mid-term, and long-term categories. This way, you only draw from stable assets when markets are down and allow your stocks to recover. Third, consider dynamic withdrawal rates. Instead of taking a fixed amount every year, adjust withdrawals based on market performance to protect your nest egg. But even with these strategies, there's a mental hurdle. We spend our whole lives saving. Then retirement hits, and we struggle to spend it. That fear is real. When markets dip, it's even harder to stick to a plan. That's why having a strategy in place before retirement is critical. It's not just about math, it's about confidence and peace of mind. Sequence of return risk is real, but with the right strategy, you can retire confidently, regardless of market timing. What's your approach to protecting your retirement? Drop your thoughts in the comments. Don't forget to like, subscribe, and turn on notifications. We've got more deep dives coming your way, right here on Financial Energy. Until next time, keep your money working smarter, not harder.